In addition to endowments and business trusts, we can also establish trusts to collectively hold capital that investors have contributed in order to reduce the costs of portfolio management. By pooling investor capital together, it's possible for otherwise small investors who could not afford to hire professional managers to ultimately employ full-time management and researchers to try to conduct better analysis of the kinds of securities that they might invest in. This helps to reduce contracting and monitoring costs between the various specialists that might be involved in operating a fund, and overall improves investor returns and frees up investors' time so that they can get to work on whatever their specialty craft happens to be, rather than each one having to learn how to manage a portfolio. Now, in general, the returns on these kinds of pools are enhanced by the use of scale, which reduces the proportion of costs related to trading and administration. A fund with, say, $50 million under management might cost the same amount to administer roughly as one with $100 million under management, providing significant economies of scale when people can band sufficient assets together. Now, overall, the risk profile of a fund is improved in two ways. First off, a fund generally holds a diversified asset base, which improves the stability of a portfolio's returns because many of the idiosyncratic factors which affect individual assets are largely neutralized through effectively risk pooling. But we also have gains that result from risk spreading. Having a pool of investors who ultimately own these assets enables the losses to be spread across a larger number of people, making it possible for individual investors to absorb a portion of a default as opposed to necessarily having to absorb the entire thing themselves. Now, as the fund's investors are the indirect owners, but not the controllers of the assets it holds, it is the fund that ultimately retains legal title over the assets in the pool, not the investors themselves. This means that unit holders don't have the same kinds of voting rights that you would have with traditional direct ownership of corporations. Effectively, all the control rights associated with collectively held assets reside with management. Now, to ensure that there is an alignment of interests between the providers and allocators of capital, a fiduciary duty is usually imposed on funds, ensuring that its managers and directors ultimately vote the fund's shares in the best interests of the unit holders of the investment fund. Now, generally, for the last 90 or so years, most countries have required that any fund being issued to the public provides a prospectus, which details exactly how funds are going to be allocated and what the fund's objectives are. These kinds of prospectus also lay down what the performance incentives are for the fund's managers, which ultimately helps to determine how it is that they're going to allocate all of the collected capital that's been assembled into this institution. So it's important for us to think carefully about how we structure these kinds of pools, because ultimately the control over these assets resides with the fund's management, not with the fund's investors. Now, the first investment fund that we actually see being used is what was called Unity Creates Strength. It was originally made available to investors in 1774 by Dutch banker Adriaan van Ketwich, sometimes referred to as Abraham van Ketwich. This was an international bond fund which promised a 4% yield, plus a lottery disbursement of any excess income above that 4%. In general, it offered a full-time manager and was ultimately designed to try to help small investors achieve better diversification benefits, much as their wealthier countrymen had done before them. So what I'd like to read to you really quickly, just to highlight the importance of diversification to investment funds, is an excerpt from a 1776 investment fund that was also issued in Amsterdam just 2 years after the original Unity Creates Strength was made available. And this one was called Profitable and Prudent, in Dutch, obviously, but this is how it translates. So here's a couple of essential quotes from the prospectus of this original, of this fund from 1776. Quote, "It is indisputable that prudent investing requires the manager to spread as much as possible monies over good and solid securities. Because nothing is completely certain but subject to fluctuations, it is dangerous for people to allocate their capital to a single or small number of securities. Not everyone has the opportunity to invest his money in a variety of securities. For the sum of 525 guilders, one can participate in this fund, which will be profitable with sufficient certainty. No one has reason to believe that all the securities in this fund will cease to pay off at the same time and that the entire capital would be lost. If one had reason to fear such general bankruptcy, one ought never invest any money. And what this demonstrates is how important it is for us to try to spread risk. At the end of the day, spreading risk is essential to trying to protect capital over the long run. And while individual speculators might prefer the kinds of volatility that's associated with concentrating a portfolio into a handful of positions, most investors, particularly passive investors, tend to favor a more diversified approach that limits the kind of risk that they are individually exposed to and limits the overall volatility of the fund's performance.